Lyft just became a publicly traded company with a stock that has so far shown fairly mixed results to the future promise of the company or the future concerns of the company. And yet that isn't stopping a lot of other companies, particularly gig economy workplace companies, that want to go public. The question is, what is the rush all of a sudden to go public? Hey everyone, this is Kevin the Apptrepreneur, and Lyft is now a publicly traded company worth around $22 billion officially. They launched the stock to a lot of fanfare. It opened above expectations, lost a lot of its value the following week, and then ended more or less where it started. It's not a terrible beginning, but it's also not a great one. It suggests there's a lot of validity in the stock market when it comes to the gig economy companies, especially since, with the exception of Grubhub and Blue Apron, no one's actually profitable. And I don't even think Blue Apron is profitable. Yet so far, these are the three companies that have actually dared to go public. Grubhub, I believe, went public because they actually were profitable and wanted to get more capital to continue to expand, and they have been using that capital fairly wisely, in my opinion. Blue Apron was losing money, but I believe they decided to go public because they wanted to expand even further and needed some new, fresh capital to do so. Lyft, their reasons are a little bit more murky. They are clearly not making any money, and as the stock is on the market longer, and I believe especially during the next payment quarter, there is going to be a rude awakening for investors. And that begs the question, why are the gig economy companies so quick to go public all of a sudden? Because now you have Uber going public, you have Postmates going public, you have DoorDash, you have Slack. Slack! Guys, I love Slack, but Slack is essentially AOL Instant Messenger. AOL Instant Messenger died a long time ago for a reason. Slack is not its own product, it is a feature on Facebook and Twitter. So the question comes, what is the rush to actually go public? Before we discuss all of that though, let's have a word from our sponsors. And today's video is sponsored by Maximo, the rideshare automation app that allows drivers to safely and easily accept ride requests for Uber, Lyft, and Postmates. Whether you drive for a single platform or multiple platforms, Maximo's custom settings can help you drive more efficient, less distracted, and help you maximize your earnings. It will automatically accept one trip, turn off the other apps, and when your trip is over, it will end it, open the other apps, and accept the next trip, all without you having to touch your phone. Use referral code APP60 and get your first month free when you subscribe to Maximo. And so we start by looking at Lyft's stock. This is what it was with the month. It's right now at $74.45, which is up a little bit. Keep in mind that they started at $72 and the high was about how much was the high? The high was like $87, I believe. And the lowest it got was about $70. As you can see, it's on the rise, but it's still not a runaway success. The other company that's public is Grubhub. As you can see, they kind of started out with modest beginnings, kind of went a little up and down, and then started to grow quite a bit, and now they're going down a little bit, and we don't know where they're going to go, but considering all the acquisitions they're making and the profit that they're making, I think Grubhub will be fine. What scares people a lot is Blue Aprons. This is where they started at about $9.34, and they are down to 98 cents. So Blue Apron is not doing well. But what all three of these pictures show us is that the gig economy public offering for stock is very unstable. I mean, even Grubhub, which does make money, seems to be going through a little bit of a suffering right now. And Lyft, despite not making money at all, is kind of struggling to figure out where it finds its place. But why on earth are all these companies rushing to join this when there's really no solid proof that a gig economy publicly traded company is actually a good deal for investors? And well, this might be why. Lyft and other gig economy giants cash in with IPOs before labor laws catch up with them. We talk about labor laws all the time here. Not because I'm a lawyer and not because I am particularly well versed in labor laws. I'm actually not. But we do discuss all the time. Is it better to be an independent contractor or an employee? I personally believe it is better to be an independent contractor, and yet I am leaning way more towards being an employee with these companies because they treat me as employees anyway. I am an employee to them, and they have taken away my freedom bit by bit, and I am sick and tired of it. And so are a lot of other drivers, and that's why you're seeing more strikes, that's why you're seeing more bills, and I think one of the reasons everyone might be rushing to go public is so that they can suck as much investment money as they can before the law catches up with them. According to this article written by Li Fang, Lyft, Uber, and Postmates are racing to file initial public offerings this year, a mad dash replete with ever-increasing multi-billion-dollar valuations. But is the rush to start trading on the public markets also a sprint to evade compliance with current labor law? Recent financial and lobbyist filings suggest that the gig economy giants are hoping to get ahead of a wave of enforcement actions, new legislation, regulatory requirements, and lawsuits that could force these companies to finally and formally classify full-time workers as employees. Virtually every major gig economy company, whether its focus is ride-sharing or grocery delivery, has fought to treat on-demand workers as independent contractors regardless of the amount of time they work. The independent contractor classification generally prevents on-demand workers from engaging in collective bargaining and unionization, and allows the industry to avoid paying healthcare benefits and unemployment, complying with standard workplace rules regarding against harassment, or ensuring mandatory breaks. Also, never mind, it gives you no way to actually negotiate your prices. Actually, no, I'm sorry, I got that actually completely wrong, on purpose, mind you. You see, here's the thing. If you are actually an independent contractor, you do have the right to negotiate your rate, and you do have a say in whether you accept those terms or not. And Uber has been controlling that aspect completely since day one. So yeah, that's why I say I feel like I'm an employee. Despite promises of high pay with flexible hours, although it definitely started out that way, rideshare workers have found that they often earn less than $10 an hour after vehicle expenses. Earlier this year, Lyft and Uber drivers faced new pay cuts, fueling unprecedented protests across California. They're still talking about the protests. So yeah, guys, gig economy workers, please, let's talk. Let's talk. I mean, you definitely got their attention. You need to keep it. And I'm kind of worried that we're losing it, but hey, it's still there, so people are still talking about it. For a lot of platform companies, profits are predicated in large part on exploiting workers, and people need to understand that, said Mayo Pinto. Okay, well, anyway, that's talking about the labor, but here's where it starts getting tricky. In filings made to the Securities and Exchange Commission, many gig economy firms concede that their business models rely on misclassifying their entire on-demand workforce as independent contractors. In a lengthy disclosure, Lyft told regulators that classifying drivers as employees would open the company up to claims for discrimination and harassment, collective bargaining, and requirements that they meet wage and hour laws. Heaven forbid. The ride-sharing company wrote that such a classification could lead to an injunction prohibiting continuance of existing business practices, and that the firm would need to revisit its existing business model. Upwork, a digital platform for finding contract labor, which filed for an IPO last year, told the SEC that an adverse worker classification determination could be costly to both the company and its clients, and could unleash lawsuits, unionization, and a requirement for the firm to pay benefits to its network of freelancers. Grubhub, a gig economy firm that provides food delivery services, told the SEC that classifying its drivers as employees would not only add legal liabilities and other costs, but would also make it cost prohibitive to deliver orders in many areas. Square, which owns food delivery platform Caviar, has made similar disclosures. You can see where this is going. These companies rush to file IPOs concedes with a flood of lawsuits from workers who say they have worked full-time jobs without the benefits afforded to full-time employees. Just last year, the California Supreme Court handed down an unexpected ruling in a case involving the courier service Dynamix that limited the scope of companies' abilities to classify workers as independent contractors. In the case, Dynamix had reclassified its entire workforce of drivers as independent contractors to avoid paying benefits at a cost-cutting measure. And now we get to the litigation tactics. These gig economy companies, however, are trying to get ahead of potential legal compliance with labor standards as they exist today. Quote, the reason that up until now, no court in the U.S. has made this determination is based largely on the legal maneuvering of these companies, Dubal said. Despite the setback in California, gig economy firms won a major victory in the U.S. Supreme Court last year. In Epic Systems Corp. Versus Lewis, the court decided that workers can waive their right to class action lawsuits when they sign arbitration agreements, contract stipulations that have become standard for gig economy workers, and we have discussed that quite a bit on this channel as well. Uber, for instance, Swifty cited the ruling of one of its first major class action lawsuits over misclassification of drivers last year. In October, a federal court decertified one of the class actions brought against Uber, ruling that each of the 240,000 drivers in the suit must submit to arbitration for claims one at a time. And by the way, they actually took their advantage. They all started requiring that arbitration, and once Uber couldn't actually keep up with it, they sued Uber for not upholding their end of the arbitration clause. One of the more clever legal maneuvers from the drivers to Ubers, and a big middle finger to the gig economy company. So, anyway, despite legal maneuvering, however, the pressure against the industry is mounting. One area where there has been a response to the precarious conditions faced by gig economy workers is in state legislators. Lawmakers in Oregon and Washington state have proposed legislation that codifies a test to determine worker classification that follows the same lines as California's Dynamix decision. In December, New York City passed the first minimum wage law for gig economy drivers. Doesn't quite work that way, but whatever. And there is renewed interest in worker classification among resurgent left-leaning national politicians. Democratic presidential contenders, Senators Kirsten Gillibrand, Kamala Harris, Bernie Sanders, and Elizabeth Warren have sponsored legislation to narrow the terms under which the workers can classify as independent contractors. So anyway, this is a very fascinating article. I'll link to the whole thing below. But as you can see from this one, Uber is in fact beefing up their lobbying pre-IPO, because I think they are concerned about, well, they've always been concerned about this, but here's the thing. As you see, here's a chart of how much Facebook was lobbying and how much Uber has increased their lobbying. Now, Facebook still, I guess, spends more on lobbying than Uber, but Uber is still raising what they spend, and they are increasing their number of issues that they are lobbying. They have actually spent $2.3 million on federal lobbying in 2018, up from about $1.8 million a year earlier. And this just goes to show that Uber and Lyft and all the gig economy companies, I think they see where this is going. And here's what we need to talk about, like you and me, because I know a lot of people do want to just be independent contractors. And I will state again, so do I. But I'm not stupid. I know that under what's going on with Uber and Lyft, we're not independent contractors. We're employees. We don't control the pay. We don't control the vehicles we can use. We don't get to see where we're actually taking our passengers. Really, the only thing that we control is when we can get on and get off. And here's the thing. If you're working full-time anyway, that's not necessarily a, how should I put it, a privilege anymore. You're doing it every day anyway. So I think what's happening is that they see that the regulation is coming. I mean, yeah, if Trump gets one more term as president, maybe this gets put off for 4 years, but once a Democrat comes in, the Democrats seem especially against Uber, Lyft, Postmates, and this whole gig economy thing, and they will push to change the legislation. I think all these companies realize they can't stay private forever, and if they really want to cash out in the company, they need to cash out now. So the companies are going to go public so they can get as much money out of it as they can. And if the regulation changes to where it's not favorable for them, well, we got our money. We're going to either sell or we're going to close shop. I suspect that's where it's going. I'm not saying that's a proven fact. It's just what I'm thinking they're doing. I might be completely wrong about that. But it is a topic that is worth discussing, and discuss it we shall in the comments below. I would love to hear your thoughts about this, whether you think this has some merit or whether or not you think this has no merit whatsoever. So you know the drill. Comment below, like, favorite, share, subscribe. If you enjoy my videos, consider becoming a Patreon member. It's totally optional, but even as little as $1 a month goes a long way to helping the channel run smoothly and get access to my Patreon's exclusive blog. Also, don't forget to check out my Apptrepreneur Vlogs channel for more content and news stories, and look us up on Facebook at the Apptrepreneur Hangouts. You have to be approved to join us, but we approve pretty much most people, so as long as you don't have like a crazy thumbnail or avatar or something, you should get in just fine. And as always, flame responsibly. Have a good one.